Johnson Matthey has revealed plans for a £200 million investment in battery technology as it aims to become a key player in the coming electric car revolution, news that sent the share surging. The company generates 60% of its £12 billion in annual sales from making exhaust catalysts for vehicles, and industry observers have warned it could be particularly hurt by the rise of electric vehicles, which do not need catalytic converters. The company's investment spree designed to future-proof the business will begin in 2018 and last 2 to 3 years. Money will be plowed into enhancing the technology behind the cathodes it makes for batteries as well as into increasing production capacity. Johnson Matthey aims to grab a chunk of a market that it estimates is worth $30 billion, £22 billion a year, when 10% of cars are electric. Electric cars are set to revolutionize one of Johnson Matthey's key markets. We want to be able to produce about 10,000 tons of material for cathodes a year in a market that could be several millions of tons, said Chief Executive Robert McLeod, speaking at a Capital Markets Day. We want to play in the high-quality end of the market and not the commodity end. Our products would probably be used in very high-end batteries such as those required to run very long distances. Sites to build new cathode material plants are currently being scouted. The chief executive said these were more likely to be in the East than the West. China is the biggest single market for electric vehicles. Johnson Matthey shares were up almost 13% at £33.37 in lunchtime trading on the announcement, which eased concerns about how the business would handle the coming bans on new petrol and diesel-only cars from 2040. Mr. McLeod said the 200-year-old company expected breakout growth from its battery materials unit and was not worried by the law change as heavy diesel engines for commercial vehicles are currently not in line to be banned. He added that hybrid engines, which will be allowed after 2040, will still need catalysts, and their more complex nature meant the catalysts required were likely to be higher value to the Johnson Matthey. Tighter regulation and more complex engineering are our friends, the chief executive added. Updating on the outlook for the FTSE 100 business, Mr. McLeod said he expected a decade of growth at a strong single-digit pace over the next 2 to 3 years as tighter regulation in Europe kicks in, with growing uptake of electric vehicles supporting expansion at a slower rate afterwards. Johnson Matthey confirmed it was expecting annual sales growth of 6%. It is targeting a return on invested capital of 20% and plans to cut £50 million of costs by improving its purchasing operations. This is on top of £25 million in efficiencies revealed in June. The bulk of the savings will be used to improve margins and support the dividend growth policy. Analysts at Morgan Stanley called the strategy a confident riposte to fears over its terminal growth given the diesel debate at the heart of the investment case, noting that until now the company had been seen as a net loser in the acceleration of electric vehicles.